Thank you for joining us today. I want to go through in a few minutes our view on what is happening in the macroeconomy and interest rates. Before I start on what is happening today, I want to set the context by looking at what happened a year and a half ago. If you go back last year to let's say March or April of 2014 and set that context for today, you'll see how far we've come as an economy. In the year 2013, the rupee had one of its most volatile years. The RBI cut rates, then hiked rates in the middle, cut rates again, and hiked rates towards the end of the year. It was a very volatile year indeed. That set the context for early 2014. 3 rate hikes in a row. The rupee being in this club called the Fragile Five. Oil at $110, $120 a barrel. The previous year we had 4% current account deficit. And the new government hadn't been formed yet. And you come to this part of the year, and what do you see? The RBI is $100 billion higher in forex reserves. The rupee has gone from being a fragile 5 currency to one of the strongest emerging market currencies. Oil is at closer to $50 rather than $100. And we have a very credible fiscal policy which is aiming towards a fiscal consolidation, bringing the budget deficit down to 3%. And yet, when you look at the rates markets, the markets haven't really participated as much as one would expect. Going back to this era of 2014, 10-year government yields in India were at about 8.8% relative to 8% overnight rate, implying a spread of about 80 basis points. As the rate cuts got underway earlier this year, this spread became inverted, and even as the overnight remained at 8%, the 10-year was trading at 7.75. But subsequently, an interesting thing has occurred, that as the RBI has cut rates by 3 times, taking the overnight rate to 7.25, the 10-year yield in fact went up above 8% recently. Why is it that the market spread today, which is very close to the same level it was a year and a half ago, why is it not come down? We believe the markets are irrationally fearful, and this in itself presents the opportunity to buy into the markets. With falling inflation, and mind you, for the second year in a row now, the RBI has exceeded or outperformed its inflation target. Last year, RBI set itself a target for 8% inflation. It achieved 6. This year's target is 6% and we are under 4. What this means is that the RBI is today in a much better position to cut interest rates to stimulate the economy, which provides a great buying opportunity in our opinion for long-term government securities. As a result, most of our funds have increased the duration to take advantage of these lower rates.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.